Hello, everybody, and welcome back to Finom Group's latest video on the markets. And today, we're going into the year end, and I just kind of want to update some of my thoughts on what we're seeing in the markets. And I know I follow a lot of folks on Twitter, and when I see some of the commentary, or I watch CNBC, I've got it playing on the background all day. I've got Bloomberg, and I see a lot of the same commentary repeated almost incessantly, given that the market just continues to melt higher. And I see a lot of comparisons of today going into year end with the strength that we have going into the year end being compared with the strength that we had going into the end of the year of 2017 and into 2018. And don't get me wrong, I see those similarities. Not quite on RSI, relative strength indicator, the 14-day RSI, which got up to like 90 in January of 2018. Like, we're not there yet. In fact, RSI isn't even above 70. But there are some things that do look like that particular time period. I get that. So I see why some folks are concerned. They're looking at the put-call ratio saying, oh my God, it's at record levels, or it's at levels we haven't seen since, well, the dot-com bubble burst. And keep it, I said it that way to make a point. People always reference the put-call ratio being as low as it is with the dot-com bubble bursting, that 2000 period, that year of 2000 when things kind of fell apart. And they tend to forget what happened for 5 years leading up to that. So just really wanted to dig into some of these concepts, as admittedly, we understand markets are overextended. They've had a really robust November. We've got extreme sentiment readings. We have things like the NIME also, with high leverage, the National Association of Active Investment Managers above 100. That's their equity exposure. And some of those things, you put it all together, and it's hard to deny the extreme indicators and the seeming froth in the market. So with that, let's kind of get into some of the details. All right. So here's a specific tweet that I had seen recently that really caught my attention and kind of gave me some of the motivation to create today's YouTube video. So we've got this tweet here from Riley Davis. This market reminds me of the end of 2017, right, into 2018, pulling forward the big EPS growth due to a large December catalyst, which everybody was expecting, being the tax cuts or the Tax Reform Act of 2017. So all of 2017, we just melted higher. The whole year, 12 months worth of nothing but uptrending S&P 500, NASDAQ, Dow Jones. The biggest drawdown in 2017 was 2.5%. So we had the catalyst there that was drawing everybody into the market. The catalyst was the end of year Tax Reform Act that was passed by legislature. And so within that was going to be a nice drawdown in the corporate tax rate. Everybody anticipated that corporate tax rate drawdown was going to basically promote very substantial year over year earnings growth come 2018. And that is exactly what happened. To the extent that the market finally did have a pretty significant drawdown, that didn't happen until February of 2018. Mike Santoli from CNBC, commenting on this right here, have made this same point often, and much of the sentiment positioning setup resembles January 2018 conditions. Now we're going to look at some of those sentiment and positioning or leverage, if you will, conditions so that we can, draw some kind of conclusion. The argument that I'm going to make is different. The argument that I'm making is that this doesn't look like the end of 2017 into 2018, but rather the beginning of late 2016 through 2017. So just for clarity, these people are indicating that the market looks like late 2017 into early 2018. I'm of the opinion the market more resembles late 2016 through 2017, which is a very different expectation if we think about what happened in the early part of 2018 and basically the whole of the year, which the S&P 500 fell 4.5%. It had a nice correction of about 13% from February through April. And then it had a 20% technical bear market in the fourth quarter, culminating in a 4.5% drawdown for the year in the S&P 500. So here's another tweet. This is from Mark Newton. And he says, those who are ignoring the warning signs now will, with their cognitive dissonance, that's human nature. We don't think about the things that we should be thinking about until the pain points are front and center. That's cognitive dissonance. It's kind of like, the smoker, right? The smoker, he finally has to go to the hospital because, his lungs are just infested and, he's just sick. He's got emphysema. He's got all these complications, all these health complications that force him into the hospital. The hospital basically says you got to stop smoking and gives him this treatment, that treatment, the other. But the reality is he's got to stop smoking. And that's the recommendation, obviously, from the physicians, doctors alike. And then he finally does something about it, and hopefully he stops smoking. That's just cognitive dissonance, at a more extreme level, of course, but it's just human nature. It's what we do. So those who are ignoring the warning signs now with their cognitive dissonance will likely fail to see or understand why stocks turn down. And yes, it's been right to be bullish throughout this trend. How one analyzes the tape and manages money largely depends on one's time horizon and risk tolerance. Totally agree. The overbought time was really January 2018. I just mentioned that. The RSI was above 90. Like, that's when it's, well, how much higher can it go? You're bound to reach a tipping point. And that is what happened into the first week of February, where we hit that tipping point. We had a 5% one-day drawdown in the S&P 500. So, here's Mark talking about pretty much the same thing these tweets above talked about, the resemblance between late 2017 and early 2018, from a sentiment, from a relative strength standpoint, so to speak. It's a lot of naysaying. In both of these tweet offerings there's a lot of naysaying, fear of good things that have happened, like to get to these levels, to see this kind of froth, to see these overextended conditions, to see this, really good breath in the market. These are good things that have happened. So when I see these kind of tweets I look at them and I'm saying, okay, that's a lot of, forsaking the good in case of something bad coming in the near future. Most of these market commentators, analysts, or strategists are always in risk management mode. It's always about managing risk. It's less about actually taking risk, which seems kind of it's weird. It's just, if you are actually in the business of managing capital, it's risk first. Know your risk tolerance, of course, but you have to be thinking about risk on. And from that point, how to manage the risk. But if you never get to the point where you're risk on, risk management, it's not a chronological feature that you should be focused on. Moreover, there is typically no market environment whereby buying stocks is the promoted idea. Like, we're not talking about buying stocks here, are we? We're certainly not talking about buying stocks here. This is a lot of what these folks in social media or on CNBC have to offer. They're not talking about buying stocks. I'd be okay if they, had another tweet that followed up and offered something like, be a dip buyer. Why? Because that's how the market works. You buy dips. You just do. The market goes up over time. Moreover, there's typically no market environment whereby buying stocks is the promoted idea. In a downturn, there's more room to the downside. That's what these people will lead you to believe, especially when we're in the midst of a correction. It's always we're going even lower. You see it on CNBC all the time. We're going lower. I think we're going to test the 200-day moving average. It hasn't happened in, throughout this, entire uptrend through the summer into the fall, here at the start of winter, but that's where I think we're going. All the time. We're always going lower, especially when we're in a correction. It seems like the sentiment is the driver of the analysis. Whatever price action is doing feeds on the sentiment, and that's the overall analysis. All right. In an uptrend, we're peaking, and investors should lock in profits. I'm okay with that. I'm also okay with the idea of rotating, because you want to compound those gains. If you're locking in profits just to put it, on the balance sheet and it's just going to sit there, that's not investing. You're not going to compound your gains. You're not going to improve your performance in the out years. All right, so both insinuate selling and fear. By the way, here is Mark Newton's call in an interview on TD Ameritrade Network Live. Now, I followed Mark Newton for several years now. I think he's a good CMT, certified market technician. He knows his stuff. I'm not debating that. And we all have our opinions. But in his September interview on TDA Network Live, he was calling for a cyclical downturn into the end of the year. It was back in September. Obviously, we're significantly higher than we were in September, and we've had a very strong melt up from the start of November to this point in early December. Can we tip over from here? Absolutely. I'm not debating that. What I'm saying is, if he had sold back then because of his outlook, you would be worse for wears. You would have missed out on a good 10, 12, 13% move in the S&P 500. Folks, that is not the average return going back to the 1920s. The average return in the S&P 500, even going back to the 1980s, is like 7%. We've moved that much in just the last 45 days. This was not the most ideal call, if I'm putting it nicely. But hey, we can all make erroneous calls. That's not the point. It's really just an exercise in showing that these professionals, Mike Santoli included, who's always on CNBC, just opinions. This is just opinions. What do you think is going to happen next in the market, Seth? What do you think is going to happen next in the market, Michael, Mark? It's just opinions. People see the market in different ways. What we want to do here at Finom Group, we dive deep. We want to dive deep. The more research we do, the more information we have at our fingertips, the better conclusions we're going to draw, and the more confidence we're going to have when it comes to allocating capital. All right, going back to the former tweet about markets looking a lot like early 2018. And again, early 2018 was after a melt up from late 2016 through all of 2017. Going back to the former tweet about markets looking a lot like early 2018, whereby the positives from the Tax Reform Act and a 14-month-long melt-up from late 2016 through February of 2018, hinted at by Michael Santelli, what does the market really look like in comparison? The table below identifies long periods of a persistent market melt-up whereby the S&P 500 did not exercise a drawdown of more than 3%. And this was that time period from late 2016, November of 2016. When did our rally start, folks? Basically that week of election, the election week. The election week was the first week of November. And we have persisted since then. We had almost an 11% market return in the month of November. And we've tacked on another almost 2% here in the first few trading weeks of December. Even the starting point is almost identical to late 2016. This melt up was 300, more than a full calendar year, obviously. It lasted basically until February 1st of 2018. To the point we still keep, the market has to correct. The market has to correct. The market has to correct. We're overbought. Folks, we can remain overbought, overextended for an extremely long period of time. And we have several times throughout history. Here's another point in time back in the mid-1990s, 1995 to 1996, pretty much a year, almost a year, 241 days, trading days. We did not have more than a 3% correction. 1995, late 2016 into 2018. 2015, well, here's another 2006. There was another long period in 2016 from, this is June, so right after the election, up to the end of October. So 2 periods in 2016, we had extended, market rallies whereby we didn't have a correction of more than 3%. So as I've offered to our Finom group members, time and time again, know your market history. And why? Just because the circumstances are different this time. Human behavior rarely differs. It's generally the one true constant when it comes to financial markets. Financial markets are an expression of human behavior. An example of market history and using history to compare to the present period in the markets is the 2009 recovery in the S&P 500 from the great financial crisis lows. We've been using that ever since May here at Finom Group, folks. The red, 2009, the blue is 2020. We came into this week about 1.5% above the 2009 analog. So if we correct 1.5% here in the current trading week, we are right on track. Again, history doesn't necessarily repeat itself, but it rhymes very well. Know your market history. How did we stumble upon this analog? Well, I'm a TD Ameritrade client. I'm a Schwab client, and they basically promoted this back in April when we bounced hard. And it was lining up just like the bounce in 2009. And it was also lining up with the bounce in 1928. So you didn't know exactly where it was going to deviate, but it hasn't deviated from the 2009, and it's just kept on. And what tends to happen with these kind of analogs is they catch fire. Hedge funds catch on to them. Other institutional funds catch on, and they start programming algorithms. And so you'll get more and more programs that are designed to basically buy on dips that occurred on these particular days in 2009, aligning it with 2020, and it becomes this self-fulfilling prophecy if you have enough volume. And apparently they have. All I've seen is increasing amounts of algorithms that are aligned with with the 2009 analog. Know your market history. We brought the chart comparison with 2020 into focus for Finom members back in late April, and it's worked out famously. While everyone is seemingly so concerned about the melt up in progress, I'm of the opinion that it's in keeping with the macro market outlook that I have for Finom Group members going into 2021. Earnings estimates for 2021 and 2022 have been steadily on the rise, despite issues surrounding COVID-19 infection and hospitalization rates. But even that has a much better outlook given the vaccination period commencing very shortly. So my pushback to the argument that 2017 earnings pull forward is different than the 2018, the 2020 pull forward is rates. We had increasing rates in 2018. We're not moving rates for the foreseeable future. Rates back in 2018, folks, or late 2017 even, we were raising rates. We started at 1% in 2017. We finished the year at 1.5%. Now, when you're moving the Fed fund rate higher, you're also seeing that the 10-year yield is going higher. You're also seeing, of course, mortgage rates going higher. And in 2018, home buyers or would-be home buyers decided, nope, sorry. At 4.95% on a fixed rate 30-year mortgage, they weren't buyers. You lost basically an industry. You lost GDP in that we were raising rates. We finished the year at 1.5%. In 2018, we kept raising rates. Finished the year at 2.5%. Like, I can understand why you'd have a bit of a lockup in the market, a bit of a buyer's rebellion or a risk-on rebellion from investors as rates just steadily climbed higher. But that is not the case here in 2020. And as we look out into 2021, we're basically at zero. So that is not like late 2017 going into 2018. This is this is one of the main differences. Why? Because the equity risk premium is better. The equity risk premium, as we can see right here, I mean, it's up sharply. The equity risk premium is the S&P 500's earnings yield minus the 10-year yield, basically. You just subtract the two and you have a very nice looking equity risk premium. The equity risk premium is high. Essentially, you want this blue line here to be above the red line. In that case, you want to be buying stocks long term. Everybody's time horizon is different. But in that sense, long term, you want to be buying stocks when your equity risk premium is this high. This is a different setup going into 2021 than it was going into 2018. There's no likeness in that respect when it comes to the equity risk premium. So sentiment and positioning we'll get to, but right now we've already identified one of the differences when it comes to going into 2018 versus going into 2021. Here comes Nime. All right, so as I've said, in my opinion, the current market feels a great deal like the market heading into and through 2017. That period included late 2016 through early 2018. Here are some of the similarities, and keep in mind what we witnessed from late 2016 through early 2018, a persistent, relentless melt up in the S&P 500 for which the greatest pullback was basically 2.5%. All right, so there's been a lot of consternation about some of the recent NIME readings. NIME is the National Association of Active Investment Managers, and the readings have been hovering around and achieving greater than 100 recently. There are many charts that will highlight that when the average exposure to equities based on this particular survey are this high, in and around 100, the market tends to correct. I don't disagree. The charts are accurate. That's not what I'm contending here. Let's go a little bit deeper. David Keller of StockCharts.com does an injustice to the narrative around NIME high readings in his most recent video. I put the link here. I do advise that you check it out. It brings me no pleasure to speak with this kind of sentiment, but when you watch the segment on NIME by David Keller, you'll see exactly what I mean. There's a flagrancy in his verbiage that you need to see for yourself. You just go 15 minutes into the video where he speaks about NIME. Look, I'm going to make mistakes. I do frequently. We're human. We make these mistakes. But thousands of people watch his videos. I'll be lucky if hundreds of people watch my videos, as we've just started our YouTube channel. But I do emphasize these points because I want people to see, the depth of research that's involved with what we do at Finom Group. All right. The degree of any correction related to NIME exposure readings is never consistent. And therefore, it isn't even worth forecasting. Like, just because the NIME gets to 100 doesn't mean you're going to correct 5% any more than it means you're going to correct 10% or 1%. There's no tell there. When it gets to a certain level, it means you can correct 5. No, that's not how it works. You just never know the degree of a correction that you're going to have. All right, so for me, when I looked at the recent high readings clustering and juxtapose it with all the commentary promoting a pullback in equities based on this particular sentiment and equity market exposure, it hasn't happened since November. Like, the readings that we've seen have proliferated since November. All we've done is melt higher. So this leads me to believe that high readings in clusters are more important than a spike in the NIME reading. So here's a table of all the NIME readings back to, the end of September. 58, 73. These are the average readings. That's what, that's the most indicative number. That's what everybody uses. 102, 87, 77. And we did have a almost a 6% correction the next week after we got above 100 here. We did. Sometimes it works, sometimes it doesn't. This time it did. You did have a pullback to take advantage of. 87, 77, 69. This was the week that we started to melt up in the S&P 500. 96. 100 again, 106. Went up again, 106 plus. Came down a little bit to 103. So we're having these clusters around, and if you want to count this, we're having these clusters around 100. I think that's more important than, say, if we went to 58, up to 102, dropped down, and just kept kind of away from 100, say in the 80s for a longer period of time, 80s and 70s, and anything less than 90. Like, a spike like this, I don't think is terribly important. But when you get these clusters, I think they are more telling. The reading in NIME dating back to September do show a reading above 100 in October, and we did have a correction. And looking back at late 2016 as a comparison of elevated NIME clusters, here's what I found. So I went to the NIME, I went to their website, and I got their spreadsheet. And as you can see here, this is all of your average readings by date. We'll go back down to 2006. Here's late 2016. So we'll start here, November, right? 98 at the end of November, jumped above 100. And here's the other thing. In social media, on Twitter, people constantly throw out this 6. The NIME reading hasn't been above 100, but for 6 times in its history. It's been above 100 like 20 plus times throughout history. It just doesn't stay there very long. So it doesn't chart well. It doesn't chart well like it hits 100. So do understand that nuance between what you see on Twitter or Facebook and people promoting it in charts. It's been many times above 100. But anyways, here's the first one. And this is right around 102 at the end of November 2016. 100. So let's say 1, 2, 3, 4, 5, 6. This is still right around 100. Bit of a drop down, but 90, come on. In here, still in the 90s, 2 more 100 readings here. We're into March of 2017, folks. March 2017. From November, December, January, February, March. We can stay at elevated levels in the market, overbought, overextended for longer than most people care to realize. We finally had some curtailment of leverage there in March through April, I'd say. And then we get back into the 90s again in May. So did anything material happen here after we dropped from the hundreds or around 100 all the way down to, let's say, 68 here in late March? Well, let's see what the chart has to say. So this is March, actually, this is March of 2016 through December of 2017. So we get to March of this was our first pullback, but it was less than 3%. This is about a 2.5% pullback. That's it. Is that really worth selling your equity exposure for? Assuming that you knew the market was going to go higher after that and pretty much never look back. So to the extent that people highlight and promote the idea, that these high readings are a sign of froth or a sign of dangerous things ahead, that wasn't the case in 2017. It had a minor blip on the radar. It's not actionable. It's not actionable, in my opinion. And if you're trying to time a pullback, it's just a really bad exercise. In 2017, you didn't really have the chance to get back in before the market was off to the races once again. But to my point, and as we saw in late 2016, the clusters are about conviction. Clusters, when it comes to leverage, is about conviction. You're convicted. These investors are convicted in their positions. They have tail. They want to be in the market going into 2021. These clusters are more material than if we just have these random spikes in the NIME index reading, in my opinion. For weeks on end, the reading for NIME was around 100 into early 2017. The market made new highs and kept making new highs throughout all of 2017. The chart below shows the S&P 500's performance with the NIME index in the bottom panel. Here was the clustering of readings around and above 100 back in late 2016 through basically into March of 2017. Look at the setup here, folks. We're not there yet. but this is the start of a cluster formation in the NIME index that mirrors what we saw here. Now, this is something, this is a spike. You see this spike here, this is basically late 2017. You have this spike here. This is not a cluster. What happened into 2018? This big dip. This spike was not indicative of conviction. These clusters are. These clusters might be. Time will tell. But these spikes are not conviction, and we can see more severe drops in the market, after such spikes. You want to see clusters. To me, that shows a sign of conviction. It's follow-up. It's build upon. It's breath begetting more breath. It's momentum begetting more momentum. No other period had such high cluster readings since late 20. Like, there's no others on this board that are as high and for as long as they were until really now. This tried, but not really. It fell off too quickly, and it was more of a gradual rise. It wasn't these clusters. This looks like the start of something that we saw in 2016 into 2017. Here's some other likenesses when it comes to 2016. 2016 was an election year. 2020 is an election year. Investors were anticipating tax reform in 2017. They got it. In 2020, investors have an equally positive binary anticipation with respect to the vaccination period and the resumption of global growth that'll bring back global earnings. The real difference here is that rates are going to remain lower for longer and more fiscal relief is likely on the way. These are what we call known knowns. So there's less unknown knowns out there, and what is unknown, we could probably manage. No wonder we're seeing NIME reading clusters like this. I mean, we can rationalize it. It's logic. So there's more likeness to late 2016 than people are really talking about, in my opinion. Another sentiment reading is showing similar clusters to the NIME index with a bullish slant. The American Association of Individual Investors survey has turned bullish over the last month or so. Just like in late 2016, we are witnessing high sentiment clusters. Here's the S&P 500. Here's 20, let's see, where's 20? There we go. Late 2016, folks. Looks a lot like where we are right now, clusters. This right here, going into 2018, not a cluster. You got this big spike. This was froth. This was after a very long period of bullishness in the AAII survey. And finally, it just tapped out. Just tapped out. That may happen here too. We may start out like this, and over the course of 2021, going into 2022, we might tap out like we did in 2018. But right now, we like these clusters, Here's at the bottom panel here is the spread between the bullish sentiment and the bearish sentiment. And again, clusters. This is what we think is different when we look at the probabilities going forward and differentiating between, are we going into a 2018-like scenario or are we going into 2017-like scenario where we just continued the melt up from late 2016? And here's another one. In studying the likeness from the late 2016, something also happened just this past week, folks, in the way of market breadth that happened in 2016. McClellan Summation Index successfully broke out of the minor downtrend that we can see here. Here's the downtrend line. Here was unfortunately a lower low. but this was a higher low from here. So most importantly is going to be the trend line and getting above this trend line. And we did last week. We broke above that trend line. McClellan Summation Index is a long-term version of the McClellan Oscillator, which is a market breadth indicator based on stock advances versus stock decline. Some more notes in here about that. But I want to get to why I think it's akin to what we saw in 2016. The NYSI breaking out and above the trend line is a strong, positive, long-term development. Furthermore, recognizes that this is a breadth indicator. What do we know about breadth? Breadth leads price. We know that. Breadth is, it's kind of the foreshadowing of good things to come. The S&P, well, and when breadth is negative, obviously, it's the foreshadowing of bad things to come. The S&P 500 forward returns when the NYSI exceeds 900 for the first time in at least a month since 2003 proves a very good reward to risk in most time frames. So the study here goes back to 2003. The criterion is that the NYSI exceeds 900 for the first time in at least a month. Here are there's a lot of green on the screen for this study. And again, it goes back to 2003. So when else did this happen? Well, it happened in 2016. It also happened in 2017. What happened after that? Well, a year later, stocks were up 14%. It happened in 2017. A year later, stocks were up 13%. Looking at it more generally, when this breadth thrust fires, 1 week later, 75% positive return. Thinking more long-term, out a month, the positive returns 79% of the time. Thinking about 6 months and a year, when this breadth thrust fires, market is up on average, historically, 6.5%. A year later, almost 12% on average, and it's up 83% of the time and 91% of the time a year later. This just happened. It happened in 2016 as well, and 2017. It also happened, by the way, in 2019, back in February of 2019. A year later, stocks were up 23%, basically into February, and then things fell apart because of the exogenous event that is now known as COVID-19 pandemic. But this is a strong signal when you see the NYSI go back above 900 within the last month. 2016, again, we see similar breadth thrust fire. 2019, by the way, 2009, it happened also. It just kind of, going back to our 2009 analog in market history and why human behavior is so constant. All right. Wait. There's more. If you thought that NYSI, if you thought that the AAII survey, if you thought that the NIME index was all we had so far as the likeness to 2016 and to 2017, there's more likeness. In terms of breadth, since we've already gone over sentiment and leverage, we're getting into breadth readings. The following chart is a compilation of all the NYSE, the BAM, and the S&P 500. What is BAM? BAM is the breakaway momentum breadth thrust indicator. And it's noted here at the bottom. You can see the BAM signal threshold comes in at 1.97 right there. What's that date, folks? 2016. It happened in July of 2016. We had a BAM, or a breakaway momentum breadth thrust. July 2016. When did that happen in 2020? June 2020. We fired a BAM, breakaway breadth thrust. Again, very similar. What we're seeing here today happened in 2016. So what happens after a BAM? breakaway momentum signal. And this goes all the way back to 1949. This study is Walter Deemer. He's another a great follow when it comes to Twitter. You should be following Walter Deemer. But this study is his from 1949. It gives us a really long time frame, obviously. But as you can see, it happened twice in 2016. Both times, a year later, stock market is higher, double digits. Historically, a week later, the market is positive, 77%. Annual return, almost 20% on average a year after you have a BAM breadth thrust. This is an older chart, and as you can see, it happened in 2019 also. This one wasn't updated to include 2019, but in 2019, it happened in January. The second week in January, we had a BAM and a Zwig breadth thrust, two breadth thrusts in that same week. And you wonder why 2019 had a 30+% return. You have two of those breadth indicators fire or momentum breadth thrust fire like that. Folks, that is people just flooding. They want in. They want into the market. I don't care what price. I just want exposure to the market. When you see these things happen, they are a telltale sign of when the market dips, you buy that dip. Momentum breadth thrust have what I call tail. These are people that are going to keep this money in the market for a reasonable amount of time, or unless something exogenous happens. Of course, that had to happen here in 2020. But even so, this one fired in 2019, and it did last. This was January, and it lasted through January of 2020. We didn't tip over until late February of 2020. You have to know about these breakaway breadth thrusts. But again, 2016, it happened in July, and in 2020, it happened in June. So if we should, 12 months later, folks, I'm just saying, know your history. Now, none of the aforementioned discounts the probability of a near-term drawdown or correction, but such an occurrence should be viewed as a long-term buying opportunity. Buy the dips, folks. So I'm not arguing with Mike Santelli. I'm not arguing with Mark Newman. I'm just saying weakness should be understood as an opportunity based on all of these studies we've just gone over, based on recognizing when sentiment and leverage starts to cluster. These are signals underneath the surface. They are signals. All right, something else on the minds of worried investors right now. The S&P 500 closed above its upper monthly Bollinger Band just this past week. Following each of the last 3 occurrences, the benchmark index posted declines for at least the next 2 months. Well, that sucks, right? The gauge climbed almost 11% last month. The S&P 500 climbed almost 11% last month and has started December with a more than 1.6% gain. So the last 3 occurrences that we closed above the upper Bollinger Band, we did have some sort of corrective behavior here, corrective behavior here, corrective behavior here. The last 3 times, that'll take us back to basically the start of 2018. The last 3 times. That's not a big sample size. So let's pull back the curtain a little further, so to speak. All right, well, it's actually happened. The S&P 500 closed November above its upper Bollinger Band. Going back to 1990, however, that gives us a much larger sample, obviously. But going back to 1990, there were 14 occurrences of likeness where we closed above the upper Bollinger Band. That's all showed in this chart here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Indicators are your red and blue lines. Well, the blue lines show you that the market did not correct. 1, 2, 3, 4, 5, 6, 7. So half of the time, of the 14 occasions, only 7 times did the market actually correct shortly thereafter? See what happens when you kind of expand your time horizon. You look at a larger sample size. But, this comes from Bloomberg. They weren't very interested in, expanding because, well, this gets people to click on the article, right? You throw something fearful out there like this, something with recency bias, 3 occasions, that's a lot of recency bias. It's going to get you a lot of clicks. All right. After a nasty cyclical bear market in March 2020, we've seen rapid policy response that served to backstop the economy and financial markets. It worked. All that backstopping worked. You don't have to like it or even agree with the policies, but as an investor, you're doing yourself a great disservice if you choose to fight or stand too rigid in the face of such powerful policy implementations. History suggests that fighting monetary and/or fiscal policy proves a daunting, if not negligent, activity as an investor. History, folks, history. With that said, here's some more history, potentially less alarming than hyperbolized means for which to assess the current and seemingly frothy, overbought, and overextended markets. So the cyclical bear market, not a secular bear market, the cyclical bear market that was resumed the secular and new cyclical bull market. Yes, this is a secular bull market, and we have been in a secular bull market since about 2013. Within the context of a secular bull market, you can have secular bear markets that resume a new cyclical bull market in a larger secular bull market. What does a secular bull market look like? Well, you make a lot of new highs, folks. Here's basically from 1950s to, let's say, 1969. You make a lot of new highs in a secular bull market. You don't make many highs in a secular bear market, which was basically from 1970 to 1981 or 1982. And then we started a new secular bull market, a lot of new highs, and it's a long period of time as well. This secular bull market basically started in 1982 and lasted until 2000. And then from 2000 to 2013, we had another secular bear market. Only one, basically here in 2007, a series of new highs, but that's few and very far in between. 2013, we start a new secular bull market. If it's anything like the secular bull market from we have a lot of time left in this secular bull market. We could see this last until the late 2020s. I was born in the 1900s, sadly. So I always, unfortunately, start my centuries with 19. But anyways, a lot of new highs. It doesn't exonerate that you can have a cyclical bear market within a secular bull market, is the point. Identifying that you are in a secular bull market happens when you are making a lot of new highs in the S&P 500. All right. Just as there has been consternation about the NIME and the AAII survey results suggesting extreme froth in the market, many point to the put-call ratio. I hate this one, by the way. At extreme low levels, concerning. I don't like the whether it's the equity put-call ratio or the CBOE put-call ratio, I don't like either of them when it comes to being a sentiment indicator. They just don't work well. You don't know when things are going to turn. You don't. So positioning contrarian to when it gets at a very low level, it's just a bad exercise as an investor, or even an active portfolio. It's just a bad way to play. You should be positioning for buying dips, maybe locking in some profits and rotating elsewhere, but fine-tuning that shopping list that you have of stocks and or ETFs to buy when the market does consolidate. The market will consolidate. It's just a matter of when. It's just a better position to put yourself in mentally so that when it comes, you're actually excited about the dip. Because the cash that you do have on the sidelines, the stocks that you do favor, the ETFs you want to get into, they're now cheaper. They're cheaper. And when you're in an uptrend, you buy dips. So here's a tweet from Willie Delwich recently, and I follow Willie on Twitter as well. More evidence of optimism and complacency. The CBOE put-call ratio has finished in the 60s 4 days in a row and in the 50s as of yesterday, or 2 days ago when this tweet was out. On 10-day basis, it's at a new cycle low. And his chart really only goes back to 2011. So he can show you that, when it gets down here, we do tend to see, a bit of a pickup. We move from this low reading, and it does tend to coincide with some corrective activities. From here, but not so much right here, obviously. So timing this for what? It didn't really materialize. Anything but a little blip on the radar. Here's a bigger picture of it, of course, and you can see. You do tend to get these corrections, but now we're at extremes. And the other thing I want to focus in on is we clustered. We're within, a couple months, we're clustering again with these low readings on the CBOE put-call ratio. We're clustering with low readings. Now, again, this only goes back to 2011. So while everyone is pointing at these low readings, and they do tend to line up, pretty okay with near-term, consolidation, if you will, within the context of a bull market. See, here's the other thing. Back in 2016 through 2017, you did not have low readings. Here's 2016, here's 2017, but the market still went higher. So not a great indicator. So while everybody's pointing at low put-call readings and heralding something ominous, when we compare the current clusters, they may not prove to be what the greatest fears have been promoting. Look at the readings from back in the mid to late 1990s. See, if you cut off this side of the box here, or you cut it off here in 2011 like Willie has, right? It does look fearful. But when we go back further in time to the mid-90s into 2000, look how low it went. It broke out of this box, these low readings, and was down here for a good 4+ years, folks. 4+ years during the dot-com era, the rise of information technology era. So this, this may not be the right time frame to use, because also remember, this was maximum complacency during a secular bear market. This is a secular bear market. This was still within the context of a secular bull market that started in 1982 and lasted until 2000. These readings here are not within the context of a secular bull market. So I don't think the comparisons, and given that we are clustering, this may be an indication that we're going to be dropping below this box, and we might spend some time below the box for an extended period of time. Everybody always harkens back to 2000, but they tend to not outline or reminisce about the 1995 to 1999 into 2000 period. They always just talk about the lowest level since 2000. They never talk about this period here. we may be on the verge of getting down here, and it would make these levels look elevated. Not a forecast. I'm not saying that's what's going to happen. Just saying keep an open mind, folks, and recognize that the box itself is more discussing a period that occurred during a secular bear market. This period was a secular bull market. We are in a secular bull market whereby we may be heading below the box. It's something to consider. And we are clustering. We are clustering just as we did back here and before breaking below the box. Something else that I recently saw, and this is from Renaissance Macro Research, talking about the first quarter of the first year of a presidency tends to be challenging. The forward returns are actually negative. Keeping in mind that the data is the data, we can't argue with the facts. We can look more deeply into the data to find the alpha. So when I saw this, I originally thought, wait, I've been around and I've been in the markets. Most Q1s that I've been involved with, at least going back to 2000, the market's been higher in the Q1 period. It tends to be a seasonally strong period. But what about, elections and the first year after the election for the Q1 period? So I decided to do a little more digging, and here is what I found. The number of negatives, see, now this goes all the way back to 1928. That's a long period of time. In my opinion, the market is not like it was, since the 70s, but if you want to push back on that, I'd say even since World War II. I don't agree with going back this far in time, but I'm not the one doing the study. I don't get to pick and choose until I decide to dig and try to find the alpha within the context of this data series. And here's what I found. Number of negative Q1 returns. Going back to 1976, the year I was born, is just 3. So there's only been 3 times after an election year with a market in the Q1 period, so January through March, was down. Only 3 times since 1976. The other, 2 of the times was 2009 after the great financial crisis and 2001 after the dot-com bubble burst. What are you going to do? But these were outlier years. But, besides that, it was just 1977. And these will skew because they were serious drawdowns in the market. These will skew. This was during a recession as well, 2001. This is going to skew the total return. If we pick those out, the market is actually higher since 1976. We can't do that though, but it's important to understand the nuances when we go and dig a little bit deeper. Otherwise, the Q1 is positive after election year on average when we include these years. Sometimes big outlier years skew the data in one direction or the other. Here's something else. A peek into January and Q1 of 2021. January tends to stay firm after an above average year. What a year 2020 has been. These notes are from Bank of America Global Research. What a year 2020 has been. After a huge correction on COVID-19 and into late March, a strong rally has taken the S&P 500 from a year-to-date drawdown of 30% as of March 23rd to a year-to-date gain of 14.5% as of December 4th. The average annual S&P 500 return back to 1928 is 7.67%. If the S&P 500 can finish 2020 with an above average return, the seasonally positive month of January stays bullish. In addition, when the previous year has an above average annual return, Q1 in the following year tends to be stronger than average as well. Again, digging deeper into the Q1 period after an election year. So here's one more thing, folks. One more thing. This chart right here. What would you say is the most interesting finding in the historical data noted below? The table identifies years in which the S&P 500 captures a 30% or greater return. As we did in 2019, the total return was 31.5%. A year later, whenever the S&P 500 has generated a 30+% return, the average return the following year is 15%. We are up, as of December 9th, a little more than 15%. Know your market history. And that's all I have for this week, folks. I hope you enjoyed our video and our deep dive. And as I always say, we can't argue with the data. We can just put it into perspective. And I think the best position to be in going into 2021 is simply to look for those opportunities whereby dips are opportunities. We are in an uptrend. We have positive catalyst, if not tailwinds, going into 2021. And assuming, because until it happens, we have to recognize it is an assumption, but assuming the vaccination period is successful, we are looking forward to a strong global growth rebound. With that, I thank everybody for visiting us here on Finom Group's YouTube channel and look forward to our next video. If you like our content, please subscribe to our channel and visit us at finomgroup.com.